Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. Corey and Chad here, your hosts for this weekend's edition. On this show, first half of this show, we're going to be talking a lot about the equity markets and some of the, let's call them newer trends that could have been established at the very beginning of this month. Also a big focus going to be on the interest rate environment as we are broadly seeing higher rates in the U.S. We're kicking off this show with Rick Bensignor, president of Bensignor Investment Strategies, writes the institutional newsletter, Supposedly Irrelevant Factors, that is read by some of the most successful hedge funds in the world. And on the retail and individual side, check out the In the Know Trader website, which I will link to within our weekend show posting. This has 3 products, a monthly report called the 7-Eleven, where Rick picks no more than 7 of the 11 SPDR ETFs with the goal to beat the S&P, a weekly report called the Tactical Trader Report, and a daily report called the Daily Tip Sheet. That was started just this year. Rick, it's always great having you on the show because we do go around a wide number of markets and you share with us what you're seeing in each of these markets, starting off broadly with U.S. equity markets, ending the week on a little bit of their back foot, but hey, all-time highs were hit mid this week again in the S&P and Dow. But Rick, the big question being, are these markets overextended in your eyes?
Thanks for having me, Corey and Shad. And to answer the question, sure they are. Now, the reality is you could have asked me that a month or 2 ago, and I would have said the same thing. Sure, they're extended. You've moved up something like, I don't know, at the peak, 23% or so, 24%, maybe even more. Actually, it may even be close to a bit more off of that October low in a straight moonshot. I think a lot of what we're seeing in the profit taking today is part of, well, I'll say a smattering of reasons why we should see a pullback. The CPI number early this week was hot, and yet the market leapt forward and actually marked a new all-time high close that day. Not an intraday high, but a new all-time high close on Tuesday. Then you had PPI yesterday, and it was a very hot number, and it took the market a little time to even decide to sell off, but it finally did, although somewhat late in the session. You got a decent bounce, and you know, the S&P closed mid-range on the day, which, you know, is showing just a tremendous amount of pent-up demand for stocks that you know, you'd see that on a day that should have obviously been a take profit day and a decent down day given how much the market's moved up in the last several months. Today, we're getting some follow through as interest rates have moved higher. You've got the dollar up, you've got interest rates up. And if you think about where the U.S. 10-year, you know, today we're at about 4.31% with a high of 4.32. A week ago, week and a half ago at most, I think it was actually even this week, we were at like 4.06. So you're talking about 25 basis point move higher in for stocks to deal with that has puts rates near the upper end of this year's range. 4.35, 4.36 or so is the high this year. You know, think back to January 1st. The street was incredibly bearish bonds, thinking that rates were going to collapse this year. To start the year, I think we were, I don't know, maybe 3.86, something in that neighborhood. I think one day this year, by a fraction of 1 basis point, yields closed lower on the year for one fraction of 1 basis point on one day. The street could not have been more wrong about the direction of rates. And yet, here's the market, the stock market, up on, or virtually on, all-time highs. So something dramatically has shifted, besides the fact that rates have gone higher. something dramatically shifted on the equity investor side. And to me, what that is an acceptance that rates are going to be what the Fed has told us constantly, but people didn't want to believe. Rates will be higher for longer. And this is proving so. Yet here we are on essentially right near all-time highs. For that to be, it has to mean that investors have shifted their psychology on being able to, at least when it comes to stock investing, accept higher rates. And in an environment where things have changed so quickly since October, and the perception being that the Fed was going to cut multiple times this year. Well, I looked, I think it was either yesterday or the day before. What was built in seven rate cuts in January is down to 4 to 5. Fed fund futures traders had priced in over a 99% chance that the Fed will not lower rates at next week's meeting. And the first time they've got targeted that they're fairly sure there will be a cut is in June. And as I said, they've got 4 to 5 cuts built in, not including if anything has shifted in the last 24 hours, because again, I didn't look at it today, or I think it was the day before yesterday that I had looked. That means that all this belief that lower rates were going to fuel the stock market is no longer part of the equation. So the demand for stocks is coming simply on the belief that at some point the Fed is going to not only stop raising rates, but lower. I think we're all pretty much in agreement that they're not going to raise any longer. But when and if they actually cut, and I think the last time we spoke, guys, I said to you, I don't think they probably cut until the fall. So I'm not necessarily in the camp that they're going to cut anytime in the next couple of meetings, the way the market is still pricing that they will. And let me tell you, 4.3% compared to being under 3.9 to start the year has absolutely decimated fixed income portfolio investors who had bet heavily that rates were going to fall. They are the ones sitting in the doghouse right now and will have very difficult years and a very difficult time answering to investors how they so got that wrong. And that's a big part of what's going on now. So with the market coming off what it is today, and the S&P is down as we talk about 35 points or so, it's off the low of the day, but it's down, and it should be down given the fact that we've got 4.3% rates. And this week also there was I think it was TD Ameritrade, which is about to be Schwab, story out today that there were record inflows this week into stock funds. And that to me is almost perfect where we may finally get some pullback in the market. You're seeing record inflows coming from the public. That makes a lot of sense to me, and more the reason why we certainly could get a pullback that's more than the 2% or so that we've gotten since October in the S&P. I mean, you really can't get more than a 2 to 3% pull down. I think now, we could finally see a little bit more than what we've seen in the past.
Well, Rick, just along that line of thinking, a lot of articles came out midweek once people had started digesting the higher CPI and then again the higher PPI a couple of days ago. I think a lot of people are looking at it the same way you just outlined it. Hey, we're not going to get as many cuts this year from the Fed as we initially anticipated, with inflation not just being stickier, but even bouncing higher a little bit. Is it possible that there was something else besides the Fed rate cut expectation that's been driving these markets higher, maybe just strict momentum or technical breakouts, and now that's reached an apex and we may get that bigger corrective move that you just mentioned? Because everybody's putting 100% of this on the Fed expectations, but we've had a couple analysts come on the show and say, I don't think it's just that. I think there's other things afoot. What do you make of the reasons behind why we've seen such a blistering rally since October all the way through present?
Well, there's several things here, Chad. First off, there was so much buying done fourth quarter last year that to me, it eliminates what was more reasonably could have come this year when and if we get those rate cuts. So the market's a forward-looking discounting mechanism. The fact that the street shifted its psychology in fourth quarter last year to the fact that the Fed was done raising rates and will in fact lower rates multiple times this year is where all that buying came in from. And it followed through into the beginning of this year. Now I think you're starting to see more saner, cooler heads prevail in realizing A, rates are going to stay up higher for longer. B, the economy is humming along even with higher rates. But it puts a dilemma in for Chair Powell of the Fed in how to handle the fact that we just got a pretty big uptick in inflation numbers, especially on the PPI side, and that his long stated goal of getting to 2% inflation he's going to have a hard time actually making that happen. And I think what could easily happen over the next several weeks is that you see some profit taking off of this run. You get a more balanced point of view on the fact that rates are going to stay elevated. I mean, you've got to get under 4% in the 10-year and stay under 4% to change at all the psychology of rates higher for longer at this point. And the fact that we just sold down to 4.05 and a week later you're at 4.31 says to me a lot about what's going on in the market, and the fact that even though you have a strong economy and even though stocks can generally do well in a strong economy, the differential in the rate environment relative to what we've seen for years, and the fact that we're up above 4% in the face of what virtually every portfolio manager expected for this year, means that there's a lot of different pieces of the puzzle coming into play right now that were not anticipated by many people in the street. And you throw into the mix the still very bifurcated market between the haves and the have-nots. And what I'm referring to is essentially the super duper large cap names versus the average name. An equal weighted S&P doesn't look anything like what the cap weighted S&P looks like. And even though we're getting a broadening out of market participation, the fact that just a handful of names is so dominant in the pricing of the S&P, to look at the S&P and to judge the market based upon a cap-weighted, so dominated behemoth group of 10 stocks, give or take, that really control the pricing of the S&P, you're looking at almost false information by looking at the S&P and saying, oh, look how good the U.S. stock market is, because it's dominated by a few names. Take out that Mag 7 or whatever you want to call the top 10, 12 names, and you have a very, very different looking chart than what the spiders look like.
Yeah, that's a very good point there, Rick. Something that we have heard, even though breadth has widened out a little bit, still very much dominated by large cap stocks. But this is still the environment where money is still going into the market, just in a concentrated sense. What does this tell you about where money could flow if we do get this pullback? If the large caps do start to struggle a little bit on less rate cut optimism, where does money move?
I think, look, there's so much talk about the Russell 2000 was supposed to have a spectacular year this year. And I've told my clients to start maybe probably close to 2 months ago, it is, where I said, start considering putting money into small caps. But I made a very clear caveat to that statement that small caps will work if, and if was in capital letters, if rates can sell off. If you got a decline in rates. if rates were going to stay up, you're going to have a very hard time seeing Russell 2000 names do well if rates are 4.25 and above. Even 4% and above is going to stymie that rally. So if the mega caps start to see some real profit taking, and we've certainly seen that over the last few weeks, if Russell is going to have a hard time moving higher, then what you're talking about is going down the cap scale from the huge names in the S&P to the non-huge names, right? So go past the first 25 names, maybe even past the first 50 weighted names. So the other 450 names in the S&P should get relative bids to the mega caps and probably mid cap. But you can't go, I think it's, small is going to have a real hard time if rates stay up like this. So it's hard for me to tell people at this point that you really want to put money into Russell 2000 names if there's a chance that 10-year is going to get to 4.4 to 4.7. May not go back to the 5% we saw last year. But if we keep, as long as we stay above 4 to 4.25, Russell 2000 names are going to struggle. So if you got to think about where you're going to put your money in stocks, I think you have to go down the cap curve, get away from the first few, dozen names that are the heavyweights in the S&P, and start going more towards what we would say is the quote average stock.
Okay, Rick. So maybe not as bullish on the small caps, but maybe some of the mid caps and some of the lower end of the larger caps, but not the very high end of the mega caps. Another sector that has been doing better than I think a lot of people expected is actually the commodities the last couple of weeks. If you look at it, we've seen oil break above 80. It's at 81 and some change at the time of this recording. We've seen gold break out. I think surprising some folks that it was breaking out in tandem with everything else. We've seen silver back above 25. It's above 25.40 at the time of this recording. We've seen copper back above $4 now. It's at 4.12 at the time of this recording. So a lot of the commodities are getting a lift. Does that tie in with the higher inflation thesis?
It's funny because it's not much more than, I think 2 weeks ago, I read two different articles about commodity prices were sagging and that people should not be concerned about commodity prices. If anything, they're indicating the opposite, and they are disinflationary, and you're not going to get a surge. Now, since then, oil, as you said, has broken over 80. Gold has made new all-time highs. Cocoa is on a 40-year high. And why do I care about cocoa? Well, I eat chocolate every single day without fail. So I was in Costco 2 weeks ago, and I loaded up on, they have, God bless Costco, they have Godiva, individually wrapped Godiva dark chocolate hearts were on sale for something like $8 for almost a pound bag. Now you walk into a Godiva store and you're paying, I don't know what, $25 for a pound. These are packaged. So what did I do? I bought 4 packages. Come home, my wife says, "What are you doing?" I said, "Honey, these things are going to be double the price in a few months. The price of cocoa is out of control, and it is going to finally trickle down, and we won't be able to see these things for this price. And considering I eat, chocolate every day, might as well grab it now." And you are still seeing the grains have been certainly depressed, but you are going to see still higher food prices. Notice, regardless if commodity prices go down, does the price of a loaf of bread in the supermarket ever go down? No. It will only go higher over time due to inflation. And when the underlying commodity ends up costing more, then the manufacturers have no problem telling us our cost is higher and we have to pass that along. Food prices will continue to slowly move up. Just now I had lunch with a few guys in the neighborhood, and they were talking about that the price of onions is double what it was a year ago. I mean, basic things in your home are costing much more. Today, oil's fairly flat, but heating oil's up, gasoline is up. The only thing that's been down and steadily down, thank God, has been natural gas. So for those who heat their homes and in the summer cool their homes with natural gas, this year should be a good year. Nat gas is $1.65. 2 years ago, at the height, right after the Russia's invasion of Ukraine, gas was over $10. It's now well less than $2. So there's the one place that I say as a consumer, you did better. But the price of commodities has started moving higher. And if you look, CRB index is heavily weighted on the energy side. So crude oil is its biggest component. Goldman Sachs commodity index a little more fairly balanced, but you've started to see this moving up again. And not that commodity prices get materially affected by the U.S. rate market, but from a psychological point of view, when you see rates moving up, it often ends up pulling commodities with them.
Rick, make more sense of this for me, please. Tugging on that last point there, because look, the inflation data that we saw this week was data from February, and the commodities breakout that we've seen has mostly come this month. So, one, would you expect that higher commodities prices to filter into that inflation data now moving forward? And in terms of higher rates, especially in terms of precious metals, don't higher rates usually mean pressure on the precious metals prices?
Yes. Higher rates are not typically good for gold because gold gives you no dividend, no interest. The only way you make money owning gold is to sell it at a higher price than you bought it for. Whereas you could buy a stock that, let's say, a nice dividend paying stock, even if the stock's flat over a couple of years, you're making money from the dividend. You don't get that in gold. So higher rates is a negative for owners of gold, and a reason why many people stop and think before they buy gold because they look at the interest rate environment. I have a CD that's actually maturing. That's within the next 2 or 3 days. And this morning I started shopping around again for, what are CD rates now? And most banks, forget the money center banks. Anybody who banks at a money center bank now is just plain foolish. There's no reason to be dealing with Bank of America, Chase, and the like, paying you, 2-3 basis points in interest when you can actually get 5% virtually anywhere else. I looked at what the rates are, and you can get a 1 year anywhere from about 5.1 to as high as I saw 5.5% for a 9-month CD. That's real money now. On 100 grand, a 5%, you're talking about $5,000 in interest. If your money's sitting in a Chase or a Bank America, you're basically simply walking away from $5,000 for every $100,000 you had in the bank. That's real money. That's also what gold traders need to think about when they invest in gold, because they're pulling money out of what now gets you, even in a money market, you can get 5%. I have my money in banks. I've shifted everything out of the money center banks, and I can get 5% just on a savings account. So when you invest in gold, you have to think about, sure, it's a hedge against inflation, You also have to think about, I'm taking money out of the bank in order to invest in a particular product. If it's gold, you're giving up, well, in anything now, you're giving up, let's say, 5% in the bank. So you need to kind of think, can I make more than 5% on this investment? Because you need that just to break even. At 2,100 plus in gold, if you're talking about 5%, you're talking about over $100 of interest that you're passing up by buying an ounce of gold. You have to think about that as an investor, and higher rates here are going to theoretically put a lid on how quickly and how much gold could rally. Now, yes, it got a breakout. It broke out to new all-time highs. And I bought some gold a week ago, and I want to see it hold up because Corey, you and I had a conversation, I don't know, a year and a half ago, 2 years ago. I don't remember exactly when it was, but when gold had that false breakdown beneath 1650. And it looked as if gold was going to really fall apart. And that was the low of the move that set up this whole move higher now to new all-time highs. If you're a gold bug, you got to see, let's call it, gold should not now again trade beneath $2,000 an ounce. In theory, it probably shouldn't trade beneath 2050, but I'll give it a little fudge room. But gold could easily get to $2,400 in the next year, simply on the momentum of the breakout. But that's not going to happen if rates go to 4.5% and 4.75%. So it's all parts of, piece of the puzzle when you're looking at the CRB and you're seeing things are moving up and oil's moving up and gold's moving up. Yes. But when it comes to gold specifically, you have to look at the factors that affect gold, the US dollar, the direction of the US dollar and interest rates being the most important. And what's the alternative? And if you can guarantee yourself a 5% return in the bank right now, which you can you guarantee yourself a 5% return in gold? So you got to make, over, as I said, over $100 in gold in the next year in order for it to make sense to buy gold. And each individual has to make that determination if that seems likely and to what degree do they want to pull money out of the bank into something that has no yield on it other than other people paying higher than you in order to force the price higher. And then will you be savvy enough to also sell out before prices come down, if that's what, ends up happening?
Well, Rick, just a quick follow-up on that, because there were a lot of people that were buying gold last year in the 1900s or 2000, even at Costco, along with the chocolate, and it has made more than a 5% move. So they have kept pace with the 5% that they would have made in a money market fund. The question is, can it keep going? Just from a technical basis, because I know you also look at technical analysis. When you see something like gold, we've had people on that are technicians, Rick, that talk about the large cup and handle pattern that started back in 2011. The other side of the cup was 2020. It bounced around, made a handle for a couple of years, keep trying to break above 2000. When you see such a large base like that and it breaks out, you mentioned it could get to 2,400, but that higher interest rates would be a headwind to it. From a technical basis, couldn't it break up to 2,400, 2,500, the extension of that pattern? And wouldn't that be a pretty good bet on the gold market? Or do you think that the interest rates would swamp the technical pattern?
You have to look at both and think about, is gold an investment or is it a trade? If it's trade, are you savvy enough to be able to figure out when to buy it in relation to what's happening in rates? I've owned gold for many years, and I'm fortunate too because I also have access to one of the largest mutual fund, gold mutual fund portfolio managers in the world. And I've owned gold well before I had a relationship with that gentleman, but he is mega bullish on gold, actually more specifically gold stocks, because in his mind they are terribly undervalued relative to the price of bullion, and he sees huge opportunity in owning gold miner names. So whether you want to look at it as the GDX or the GDXJ, which are the junior miners. He sees huge potential for these. Now, I think part of gold's rally, more from a psychological point of view than anything else, is what's happened in Bitcoin. The fact that Bitcoin has surged over, last summer Bitcoin was 25,000, and now today it's about, 68,000, but it was in the 70s, even in the last 48 hours. Now, I had argued with you earlier, 6 months to a year ago, that the rise in Bitcoin was taking money away from those who might have put it into gold and chose, an alternative asset to put it in, but one that to some degree, in theory, is a hedge against whether it's inflation. You could look at crypto as also a hedge just against the whole monetary system, but it certainly hurt gold's prospects, because money that could have gone into the gold market ended up going into crypto. And clearly the return in crypto has been far better than the return in gold. I'm a traditionalist. I have a tiny, tiny position in Bitcoin. And when I say tiny, it is a small fraction of 1% of my portfolio. It's virtually nothing. And sure, it's doing fine, but I grew up in an era. I'm a child of the 1960s. To me, I've always thought of gold as being something that I want to have as a part of my portfolio. It has continuously been. I added to it, as I said, about a week ago on the breakout above what had been the prior new all-time high that was made, I think, late November or early December. But I want to, before I really kind of put in more, I want to see that this actually is going to last and gets follow through buying. And you look at what gold has done this week, it's down on the week, and you're not really seeing much follow through at all. Now, it's early in the whole scheme of things, but if this is a real breakout before I put more money into it, I need to see that it actually is going to even stay above what was that high just from a couple months ago. And we're already kind of playing with that. That was, I think, 2152 in front month futures. Let me look, I'll tell you. Yeah, 2152 was that early December high. So right now, gold's kind of in the low 2160s. I can live with the pullback here, but I don't really want to see gold even get to 2050. So I can't tell you that I'm a confirmed bull. I'm playing enough, added some, but I'm not throwing a lot more money into gold right now. Not with interest rates doing what they've done.
All right, interesting call there, Rick. And you know what? You can make the argument that at least it is consolidating above those highs, but as you said, it's playing with them a little bit. Can I get a little bit more information on your view on the gold miners? You alluded to it back there, but the GDX chart, if we just look at that, is such a different chart than gold's chart. Longer term chart, you can make the argument that it still hasn't really broken out of this multi-year downtrend, but it is well off of its lows of 2022. Back in the kind of late Q2, Q3 there. So what do you see in a chart like GDX?
Look, we've got a double bottoms from the October low in GDX occurred right around the same time stocks made their bottom. We then sold down to that same level in February, in the middle of February, and then got a bounce, and then even late February. So you've got a good, and now it's bounced from, let's call it, in and around 26 to up to near 30. So percentage-wise, very, that's 12% or so rally, very solid rally. But this thing isn't close to being near highs. The all-time high in the GDX is back in 2011, north of 65. This is trading less than half of that. And that's why I at least understand the perspective of why this particular gold fund manager says, gold miners are so cheap relative to the underlying commodity. They are, but this still has plenty of technical resistance at multiple levels. First, I put near kind of the 36 neighborhood. Then you're talking in 2022, you got to, 41-ish, give or take, 41 and a half. And in 2020, when you had COVID and then the whole reaction to the stock market selling off and gold rallying, the GDX got up to 45, and kind of a spike high up there. And then it sold down for a few years from middle 2020 to the low in 2022. GDX went from 45 down to 22. I mean, it cut itself in half. And yes, it's above there, but this has got a long list of, if you're talking about charting, technical resistance areas that need to be hurdled in order to really change the picture here. And it just hasn't done it. I remember buying, I think it was maybe 2012 or 2013, the GDX in my own account at like 28. And here we are, 10 years later, and we're still trading there. It's done nothing. Gold miners have not been a good investment at all. not only on their own, you've made nothing in 10 years, but certainly versus just having been in the S&P instead. I always look at anytime somebody says, I like this sector or this commodity, I always think of it in terms of either cash, what's cash yield me? And up until recently, it yielded you nothing. So it wasn't really a serious thing to look at. But I always look at it in terms of, the S&P. I mean, if you're going to make an investment, you think of, what's the market return? So few people ever beat the market that you still generally, to the average listener, to the average investor, you are far better off buying spiders and Qs, QQQ, which is the NASDAQ 100, instead of trying to pick where to be. I make a living out of picking where to be and advising some of the biggest hedge funds in the world of where to be and when to be where they are. But for the average person, you're just better off, A, being invested for the long haul, and B, just picking the S&P and the Qs, some passive indexes, instead of trying to be a hero. For every NVIDIA you might have been lucky enough to have bought, there are also long names that have gone nowhere or gotten decimated. A few years ago, marijuana stocks were as hot as could be. Tilray was trading 100 and, 20, and what's it now? Single digits, something like that. I mean, it's very hard for the average person to pick what's actually going to be real winners over time. You're just better off being invested in the market and using the passive indexes, the low-cost passive indexes, whether it's Spiders, VOO, which is Vanguard's S&P 500. You want to pay, under 10 basis points in fees and just invest in the market as in a whole. Because again, you put money in gold, that's fine. But look what happened if you put money in gold. Well, gold has made money in the last 10 years, but gold miners, if you played it on the equity side, you've made absolutely nothing in a period of time that the S&P has had a huge run higher. So generally, most people are just better off being in the market in one of the major passive indexes.
Yeah, Rick, it's a solid point. It's very few fund managers that can even beat the indexes, no matter what sector they're in. And there are sectors that have their moments in the sun where they shine. There have been times where the gold stocks or silver stocks rallied, but they were very short-lived, and the S&P over time has definitely outpaced them. Now, I want to just circle back to one more time to the crypto verse, because those investors would argue that they have been beating the returns in the general markets lately. Now, granted, it's an insanely volatile space. It was crazy in 2017, and then it crashed by 80%, and then it was crazy a couple of years ago and crashed again. Now it's up in a big way. It's already rolled over by 8% just in the last couple of days, though. Do you think that the cryptos, in particular Bitcoin and Ethereum, the two leaders, can they keep outpacing the general markets, or are they actually trading as a leveraged play to the markets, because as the markets turned over, they just turned over in a bigger way?
Two ways to answer that. First off, specifically in something like Bitcoin has limited supply. And if now that the SEC approved the 11 Bitcoin-related ETFs a month or two ago, if the brokerage firms and the strategists on Wall Street, seeing what Bitcoin has done over time and making new all-time highs, if they even recommend that the average person should put 1% of their money into Bitcoin, this thing still has a huge amount to go on the upside, simply because of increased demand and no supply. Limited supply, and now very little supply. On the market, you have huge inflows into these ETFs and not a lot of natural sellers. Because most of the people who buy Bitcoin buy it because they believe it's going to double or triple or go 10 times the price of where it is. No matter when they bought it, those who believe in this game and this story think it's going to go up 5, 10x. So specifically something like Bitcoin, if there becomes more universal adaptation and belief that even if you don't believe in it conceptually, if you have a financial advisor say, look, put 1% of your money in there. It's a very small amount. If it goes to zero, it's not going to kill you. It's 1%. But if you have all these people buying 1% of their portfolio, then this thing still, given the limited supply, then Bitcoin specifically could still go well higher. I myself sold out of half my Bitcoin just, I don't know, 2 weeks ago or something at 57,000. And as soon as I sold out, shot to 67,000. I sold half of what I have for reasons of, the models I use and where it was relative to, former price or whatever. Obviously, in hindsight, not a good sale. I lived with it because that's what I do for a living. But I'm willing to hold on to, the very small amount I have left. And, do I hope it goes to $200,000? Sure. I couldn't care less either way, frankly, because it's such a tiny piece of my portfolio. And when a good friend of mine tells me, I've been telling you to buy it, Rick, I keep telling you to buy it. You're missing the point. The thing is, to me, it's no different than if you had, were smart enough to have bought NVIDIA a year ago or 3 years ago, or Apple when it was trading for, $7 and things. It's just one name in a big portfolio. And even though it would have been a home run if you were long Bitcoin from 10,000 and now it's, near 70,000, it's just one name and a whole bunch of names that you're going to have. And I frankly couldn't care less that I, quote, missed it or that I didn't have a lot more of my money in it. It's something I still can't wrap my head completely around. I don't think it's going to have the universal acceptance that the Bitcoin Kool-Aid drinkers believe. And is it a way to potentially make money on a speculative basis? Absolutely. But you also have to be savvy enough to know when to get out before this potential tulip mania falls apart. And it may or may not. I don't know. I don't know where Bitcoin will be in 5 years from now or 10 years from now. If it'll be, 10 times the price it is now, or if it'll be virtually zero. I don't know. It's the type thing that I understand from the point of view of those who have drank the Kool-Aid on it. I understand why they have, but it's not my nature to go put 10% of all my investable funds into one name. Never do that, no matter what it is. So it's just one of many, many, many types of assets and securities you can invest in.
All right, Rick, we'll wrap it up here. Thank you for spending all this time with us and really focusing on some of the commodities as well, but also the cryptos and the markets. It's a pleasure having you on the show. We'll chat again next month. Again, if you want to follow along with Rick and all his moves in the markets, you need to check out the In the Know Trader website and the 3 products that he offers to more of the retail and individual traders. Rick, thank you so much for your time. I hope you have a great rest of your weekend.
Thanks, Corey and Shad. Thanks for having me.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. Providing unique reporting on markets and companies since 1990. This is the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And we are now, as promised, shifting our focus more specifically to the resource sector as we are chatting with Matt Geiger, managing partner at MJG Capital. Now, Matt, we're going to focus a bit more on copper throughout these two segments because as we're recording this about halfway through the day on Wednesday, copper is now poking its head above $4 a pound. We'll see if it can extend on some of these moves, if it can even hold above $4 a pound. But hey, there's plenty to talk about when we are seeing some of these moves in commodities broadly. First and foremost, let's talk about your attendance recently at the PDAC. Last week, look, we all know that it's the biggest resource conference in North America. A lot of different companies attend, a lot of different governments attend as well. Matt, what was your takeaway from PDAC? And on the back of PDAC, while it was happening, gold was also breaking out. What was the vibe like?
Thanks for having me on again, Corey. It's always good to join you on the program. I guess the quick thoughts on PDAC. Got back roughly a week ago. Pretty short and sweet trip for me. I had quite a few travels in the weeks before, including a site visit to Eritrea, of all places, to see Alpha Exploration's Kirkasha project there, as well as attending Mines and Money Miami just ahead of the BMO conference. So I was there the Sunday through Tuesday. I guess the quick thoughts would be, first, beautiful weather, very un-Toronto-like. I brought my overcoat in vain, so you're actually able to walk outside without risking frostbite. So that's always a plus. I guess the second point is that it was quite busy. So I'd say for those that were looking for empty exhibit halls or, speaking sessions with 4 people in the audience, as a contrarian indicator, would have been disappointed. There was a lot of activity. The conference seemed quite full. I'm not sure of the total attendance numbers at this point. They've actually probably been released already, but it was definitely a healthy attendance. I'd also say, and again, I haven't seen empirical data to support this, but anecdotally, there really did seem to be a bigger Aussie contingent than I've actually seen ever in my attendance at PDAC. I think the Aussie push in North America, particularly for lithium, probably had played a part in that. But definitely quite a few Aussie groups, both on the issuer and in investment side, were at the conference. And then I would say the mood was definitely buoyed by gold's breakout above 2,100, which occurred on the Monday of the conference. So it couldn't have been better timing, at least as a mood boost. I really do believe if the conference had been held just a couple weeks earlier, there would have been a lot more doom and gloom and desperation. But gold's price action definitely helped lift the mood amongst the attendees.
Yeah, Matt, nothing changes sentiment like price action, and it's so quick that it can turn. It's kind of shocking how fast things have changed, not just for gold, but a little bounce in silver. As we mentioned at the onset, a bounce in copper, and it seems like in general, a little more interest in the resource stocks. Just before we switch over to copper, though, were there any other metals or any other commodities that you noticed a change at this PDAC versus other conferences? Like, how was the read on lithium or uranium or critical minerals? Was there anything else that jumped out to you?
Well, there's definitely a buzz around uranium. Uranium's quite hot right now, so I'm not particularly interested in that metal as it stands. Of course, circumstances can change, and there has been a little bit of a pullback in the spot price as well as the issuers. But yeah, I would say uranium was, aside from gold, just due to the price move happening in real time, uranium was the topic du jour. Lithium is obviously very depressed at the moment, with prices down 80% year over year. Seems like we could be getting closer to the bottom here, so I don't think lithium's a terrible contrarian opportunity at this point. But there still was a large contingent of lithium players there. I think largely because of the vast amounts of money that were raised just 12 or 18 months ago. So a lot of these companies are still sustaining themselves from capital raises that occurred during 2022 or early 2023. So those are probably the 3 metals that jumped out. Still not a huge buzz around copper, I would say, at least amongst the investors. But we've heard repeatedly from the largest miners in the world that they're focused on increasing their exposure to this metal, and we can get into that a little bit more.
Yeah, let's talk about copper. As I said on the onset, it is above $4 a pound today. Still a number that people have been throwing around as much higher than just over $4 a pound, but any sort of progress here that we can get copper at levels that we haven't really seen since last April. Matt, what's your thought on, now that copper has broken above $4 a pound, if it withstands this level, what do you do when it comes to investing in copper plays?
Well, I would say it is a topical day to discuss copper, at least in terms of how the MJG fund is positioned. Copper is actually our largest metal by weighting, by quite a large margin, by over a 2x margin at the moment. So roughly a third of our overall portfolio is weighted towards copper-focused names. And of those names, one is a royalty company, two are prospect generators, and then three of them are explorers. I can name a couple of them just because I've written about them in previous MJG letters. Elemental Altus with its Caserones project, or royalty rather, which is by far the most important royalty within their portfolio. They also have some copper exposure to Cactus, which is Arizona Sonoran's project that is nearing production, hopefully in pretty short order here. I've also written about Lara in recent MJG letters. That's a copper-focused name focused on Brazil, with Planalto and Liberdade providing Lara's primary exposure to the metal. And then in the most recent MJG letter, I wrote about Altius Minerals, which, to be clear, I actually classify as a potash-focused story, at least as I look at our portfolio allocation. So that 33% weighting to copper does not include our position in Altius. However, Altius does have very healthy exposure to the red metal, largely due to their Chapada stream down in Brazil. That's Lundin Mining's operation down there, and then a couple of development stage copper assets, most namely Adventus's Curipamba project in Ecuador, which seems to have had a permitting breakthrough just in the past few months. So I should state, even though we are very exposed to copper, this is not a huge macro bet on my part. As you know, within the MJG investment process, I really try to de-emphasize the commodity of focus and instead put much more weight on the people involved and how they're incentivized, the quality of the company's assets, assuming flat metal prices, the disconnect between the company's current price in the market and what I deem to be fair value or expected value, company's capital structure, upcoming catalyst, jurisdiction, et cetera, et cetera. That said, I do consider the commodity of focus towards the end of the investment process. And I definitely view exposure to copper as a plus. So even though we're a third weighted to the metal as is, I definitely don't feel overweight the metal. And so I could see another copper focused name or two come into the portfolio, but only if the very specific investment opportunity justifies it.
Well, Matt, just along that line of thinking, looking at the copper stocks, I think it's interesting, first of all, that you have some exposure through royalty companies and prospect generators, as well as discovery plays. But when you look at the copper stocks across the board, there's a big disparity between how the producers have done, and this is true of a lot of the base metals, and then how the juniors have done, the explorers and developers. It seems like the producers have actually held up pretty well over the last couple of years. There was that big spike back in 2022 when the Ukraine war broke out. And we saw a $5 handle on copper for a while. But the producers have held on to a lot of their gains, and a lot of them are pretty close to highs or still hanging in there, where you look at the swath of junior developers and explorers, and a lot of them have barely gotten off the mat or they're at 52-week lows. Do you see opportunities there to exploit in the juniors?
I do. But to be fair, I don't think that's a phenomenon that's unique to copper. I think you could make the same argument for gold or across much of the rest of the junior sector. There's a huge bifurcation between the actual metal prices and the share prices of the world's largest producers relative to the junior end of the spectrum here. So I do think that presents an opportunity. It doesn't mean that the juniors are going to move immediately, but I do feel quite bullish at this juncture because the juniors are so beaten down, sentiment is so beaten down, and liquidity, if you just look at the volumes of some of these companies, is slow to a trickle. I do believe money will return to the space, and as a result, when it does, I think the moves could be quite explosive. But as it comes to copper, just taking a step back, I really do feel that it all comes down to supply. The metal price is well below the incentive price or the price necessary to incentivize new production coming online, which I would ballpark around $5.50 per pound. So we need to see copper move roughly 40%, I would argue, before we really see these next generation of copper mines start to look quite attractive on paper. And Brian Dalton from Altius Minerals makes this point. If you look at previous metal price cycles, oftentimes it's not out of the norm to see the metal price need to go up to double the incentive price before you truly see the big boys push the red panic button and throw everything they have at pushing forward their development assets. So I think there's quite a bit of runway even from this $4 level. I'd also say something that's unique to copper, there's really long lead time between when a construction decision is made and actual nameplated production is achieved. We're talking 3, 4, 5 years for the copper assets that actually have enough scale to make any dent into global demand. And so this is not a 12-month exercise like you'd see for, or 12 to 18-month exercise like you'd see for a medium-sized gold mine. These are mega projects that come with major CapEx overrun risks as well as risks to the timeline. And put another way, Joe Mazumdar, in one of his recent Exploration Insight newsletter issues, he included some good data. If you look at the lithium assets that have come online during this century, there's roughly a 4 to 7 year lag between the initial discovery being made and the mine actually being brought online. Actually, in the world of mining, that is a laser quick time frame there. Whereas if you look to copper, we're closer to 16 years from initial discovery to actual production in terms of the mines that we've seen brought online this century. So I think that's important to keep in mind. And then finally, I'd just say to your point about the juniors and opportunities being presented, there is an exit plan when it comes to copper. Except in rare circumstances, for junior investors, value is crystallized when, in a best case scenario, the project is sold to a larger miner who then takes it forward from there. And no offense to lithium, and again, I do think lithium presents an interesting contrarian opportunity at this point. But if you make a world-class discovery, really, who is there to sell it to? Sure, there are the lithium majors. There's SQM, there's Arcadium, there's Albemarle. Rio has expressed an interest in lithium, but notably BHP and Vale have steered clear. A couple Chinese, larger Chinese groups, Zijin, CATL. But you can really count the number of big boy potential acquirers on one hand. But if you run the same exercise for copper, you won't be able to stop counting the names. You have BHP, Rio, Vale, at least half a dozen groups in China. Clearly the gold majors. Newmont, as evidenced by its recent acquisition of Newcrest, is very interested in the red metal. Barrick, Mark Bristow, CEO there, cannot stop talking about copper and his love for the metals. You have the sovereign wealth funds. And then, of course, the group of copper-focused miners led by Freeport, and you could lump Lundin and Taseko and some of these other groups into that basket. So each one of these groups mentioned has stated their interest in increasing their copper exposure, which I think bodes very well for any junior miners that are able to discover and or develop a copper project with decent economics and enough scale to make a difference to these companies.
So, Matt, let's focus again on the juniors then. For those investors that maybe want to dive down into the juniors, they do see that disconnect. What are some of the keys that you look for when you're analyzing these junior companies in this current market environment where, look, all the juniors are cheap compared to the majors?
Yeah, well, I mean, it really does depend on business model. So if you start all the way at the prospect generator spectrum, I mean, one of the key metrics to look at, and I look at quite a few of them, but it's partner spend relative to enterprise value. So the more money being put into the ground over, say, the next 12 months relative to every dollar that the market is valuing you for, the higher that ratio, the better. So that's one metric that I would look at from a PG perspective. From the explorers, that's much more difficult. That's much more geology focused. And I rely on a network of geos that are generous enough to give their thoughts on particular discovery stories. If you look at the development stage companies, I do a risk-adjusted NPV analysis. So look at the project through the lens of discounted net present cash flow, discount it relative to the stage of asset, and then look at where the market is valuing the company currently. And you can also do that on an absolute basis and then compare it to peers. Sometimes you'll find a large disconnect. Oftentimes that disconnect is warranted, perhaps due to social or permitting concerns, metallurgical concerns, infrastructural concerns. There's a whole reason why a given project would be valued at a much lower multiple relative to its peers. But occasionally an opportunity emerges and a company and their asset is simply mispriced. And then in terms of the royalty companies, I'll usually look at their cash flow multiples relative to peers. And if you're willing to really dig deep, do a sum of the parts analysis. So even though I do like copper as it comes to the royalty space, I don't view a copper royalty and apply any higher multiple than I would for an iron ore or gold or a potash royalty. So I like the metal. I think it has a tailwind at its back, but I don't place an extra premium on cash flow when we get to the royalty stage.
Well, Matt, when looking at some of these copper juniors, the other issue is, as you mentioned when you first highlighted the copper story, there's huge lead times to get them built, but there's also huge cost to get them built. And so you look at these juniors and they may develop either the high grade underground scenario or the large open pit, mega pit scenario. And in either case, the capital needed to get these projects built are so much larger than the market caps of the junior companies. I'm talking 8x, 10x, sometimes 20x multiple of the actual market cap of the junior to actually fund the project. Do you look at strategic partner interest? Do you look at how they would ever fund a build? Because I think that holds a lot of the copper juniors back. What are your thoughts there?
Yeah, I think it depends on the stage of the company. I mean, if it's a recent discovery or a PEA stage project, we still got many years to go before raising construction financing even becomes a concern. But I think your point is fair. And it's hard for a junior to build any type of metal deposit, but a copper porphyry project that is best left to the big boys. So I think in those scenarios, if there's a huge disconnect between the initial capex and the junior's market cap, if the economics look good on paper, even with the high initial capex, and good on paper to me means NPV as high as possible relative to the initial capex, certainly well over a 1-to-1 ratio, an IRR north of 20% after tax, and preferably north of 25% after tax, and a payback preferably under 3 years. I understand sometimes for these long life porphyries, it could be a little closer to 4 or 5. But you have to prove up the economics on paper. Maybe you're lucky enough to catch, a real copper move if we were to break out into all-time highs, and we could see valuations re-rate in a pretty quick manner. But otherwise, I think the name of the game is to package up the project as best you can, and then to sell it to a bigger party to take it forward. Because to your point, it's just so difficult to actually build one of these mega copper mines. Even the major companies for the truly world-class deposits are looking to partner with their peers and split it 50-50. Just because they don't have the financial and particularly technical resources to actually build the mine on time and on budget. So to expect your average run-of-the-mill junior to be able to do that themselves is pretty unrealistic. But that doesn't mean that a good-looking porphyry in the hand of a junior wouldn't be valuable to a larger party and couldn't be sold on at some point.
So Matt, what's your investment thesis for some of these de-risked copper assets? There's up to maybe a dozen of them around the world in all different jurisdictions that have billions of pounds in the ground. They have de-risked the project to the point that they have economic studies out, but again, they cost a lot to build. These do seem like they're next on deck to be built, but again, that financing needs to come through. Do you have an investment thesis for these type of projects and companies?
Yeah, I think these projects will go. It's just a matter of timing. We could easily see $10 copper 4 years from now, but if the global economy falls apart in the next 6 months, we could see $3 copper first. And if you're invested in one of these later stage development plays, you'd get hurt in that scenario. So investors just have to keep in mind the risks. I think for junior companies that have one of these large scale, later stage copper development projects in hand, it's a bit of a fine line. There's really two things you want to accomplish. You want to keep moving the ball forward so you can get that project as close to a potential final investment decision as possible, understanding full well that you're not likely to be building that mine yourself. But at the same time, you also want to manage shareholder dilution. So if I'm looking at one of these companies, one of the first things I'm looking at is their cash balance relative to their monthly or quarterly burn. How long can they continue to move the ball forward, hopefully in a measured manner, without having to come back to the market for a fundraise? And really for any type of junior, and it falls into the category here, if I see a company needing to raise in the next 6 or 9 months, unless there's some insanely big catalyst that I'm confident of occurring in the near term, I'm very likely to just wait on my hands and then evaluate the placement when it comes. But again, it's for these companies, it's a combination of pushing the ball forward to dress it up as much as possible for an potential acquirer, while also not blowing their brains out on a dilution front.
Well, Matt, one other area of copper that I feel like we haven't touched on yet is all the companies that are gold, silver, nickel, PGM based that have copper as a serious co-credit. I don't just mean like an extra kicker, but sometimes companies have a 10, 20, 30% weighting to copper along with their gold, along with their silver, along with their nickel. Do you ever look at playing it that way or playing metals that way where there's such a nice co-credit that it's a nice kicker for another project?
Yeah, I mean, I'll push back on that, Chad. You're absolutely right, but again, I try to screen out the metals of focus whenever I'm evaluating a new investment. So I'm not going to look at a particular company or a particular project just because they have copper as a byproduct. If it checks all the other boxes and then I look at the metals of focus and there is a copper kicker, then I view that as a positive. I mean, all things equal, I would rather have copper exposure than exposure to zinc per se. But I'd much rather buy a primary zinc deposit with an excellent management team that's cashed up with a project that makes good sense at current zinc prices than I would, buying a mediocre copper deposit with an inexperienced team and no major catalyst to boot. So, I'm not going to get too carried away with looking for copper co-credits. I do believe that later on down the line, if said company that you reference is able to, advance the ball that far, there are opportunities to use that copper stream in terms of part of the financing solution. So we've seen Generation Mining, for instance, has done something similar with their project. So it can provide an ace up your sleeve for later on down the line if you actually do intend to build the mine. But to me, it's not a big enough factor to justify an investment based solely on that.
All right, before we wrap up this show, then, Matt, I want to circle back around to the underlying catalysts for the copper price. We've heard year after year about the supply and demand deficits and how copper needs to be so much higher for these mines being built. But in your eyes, you've already mentioned recession and how that could impact price. In the near to midterm, what is going to drive the copper price?
I think it comes back to supply. And if you're looking at the upside scenario, be another Cobre Panama-like scenario, which can happen at any time. We've also seen very significant production curtailments that have been announced in the past 4 or 5 months among some of the world's largest copper producers. So we could continue to see some of the bigger boys revise their copper production forecasts downwards, which could also provide upward pressure on the price. But one of the beauties of the metal, at least on the supply side, is that I don't see there being a downside surprise. The size of the copper market is already so large that even if there's this, entirely world-class deposit that's discovered out of the blue, massive in scale, it's just not going to be enough to truly move the copper price. And as we previously discussed, even in a best-case scenario is, going to be 15 years away from first production. So I think any surprise on the supply side is going to be to the upside.
All right, Matt, thank you very much for your time on this weekend show. Again, Matt is the managing partner at MJG Capital. Thank you, everyone, for tuning in to this weekend show. Be sure to visit our website, kereport.com, and podcast The KE Report to listen to all of our daily editorials and company updates from throughout the week. Thank you all for tuning in, and I hope you all have a great rest of your weekend.